Hello everyone, my name is Rohit Nair and I'm representing Ravnair Financial Services. We are in this field from the past 35 years and I'm the second generation in business. Today we want to talk about an interesting topic called as capital gain tax. Now what is a capital gain tax? Let's say you invested some money. Let's say you invested 1 lakh rupee. You have earned interest on that. Let's say that interest is 2 lakh rupees. So total value today is 3 lakh. Now the capital was only 1 lakh. You've earned 2 lakh rupees on top of it. So that gain of money is called a capital gain. Now, in the country like India, we have a capital gain tax. Any country has it, by the way. Now, capital gain tax is termed after, so there is a short term capital gain tax and long term capital gain tax. Short term is below 1 year, long term is more than 1 year. Now, I'm talking purely about mutual funds, just for us to understand. And then there are different other instruments also where capital gain tax is applicable. But let's take for now mutual funds for us to understand, okay? So, after a year, in India, we have a facility that the first 1.25 lakh of interest earned is taxed to. So every year, an individual can actually remove 1.25 lakh from his interest earned and pay zero tax on that. That's effective, right? So you can, if you have a bigger portfolio, you can start doing that and you have a effective zero tax on the interest earned. It is going to impact the portfolio growth definitely, but there are people who want to also have tax effective returns to be utilized for themselves. You can do that. Now, let's understand what the capital gain tax in India is. It is at 12.5%. Okay. So, if you are earning money, 12.5% of the interest earned is going to be taxed at 12.5. So, interest earned is going to be taxed at 12.5%. Simple. It is a developing country, and that is why this is the tax law. I've generally studied the capital gain taxes in different countries, and you will see that the number is quite higher than what we have in India. Let's take an example. Uh, the long-term capital gain tax in Japan is at 15%. The long-term capital gain tax in China is at 20%. United Kingdom, UK, it is at 20%. US, it is at 20%. Canada, it is at 25%. Germany, it is at 25%. France, it is at 30%. So if you see, developed countries have higher capital gain tax. What it means is in India also, there are 100% chances that a capital gain tax will increase in the future. So whatever returns you want to make, 12.5% you want to pay as taxes, but if that tax slabs are going to increase, that means your returns are going to reduce. And because it is fluctuating and not guaranteed of what the tax slab would be, you need to very strategically decide what is the amount you want to make, what is the taxation that can happen on it, and see how it goes in your personal finance. So while you select instruments in your personal finance, make sure that 33.33% of your investments are tax free. Select a basket like that. 33.33% are taxed at the capital gain tax levels. And then the remaining 33.33% can be taxed at your tax slabs. Right. So you will have effective taxation done. Some people would want to have more tension free life, try having 50% of your portfolio which is tax free, and 50% can be taxed because you're also going to take advantage of the market. Generally, instruments which are tax free are instruments which are not really connected to the market that much. This can be insurance policies which are tax free return. This can be ULIP plans which have tax free return till an investment of 2.5 lakh, but 2.5 lakh per year is a very good investment in a ULIP plan for the next 10, 15 years is going to give you good returns, which is again tax free. So some instruments like that can be used. But that's about capital gain tax. A short brief for you. Short-term capital gain tax today in India is at 20%. Long-term capital gain tax in India today is at 12.5%. And this is going to increase in the future years. I'm expecting somewhere about 15% in the next 4 or 5 years, and then going to around 20% in another 4, 5, 6 years. Uh, that will be like an effective taxation ideal because that's what in developed country it is. India would take a lot more time to be a developed country. I'm not saying like 50, 60 years, but yes, 15, 20, 25 years. And then that point in time, the country will require a lot more money. So they are more to collect in the form of tax. And whatever tax avenues they have, they use all of them. So I'm sure we will increase taxes here also. So plan your investment wisely when you're doing your personal finance.